I've been investing for over 11 years now, and I've made every mistake that you can think of. But in the last 4 years, I've made over $300,000. So I'm going to compact over a decade of investing experience into this one video. Number one, start today. Everybody wishes that they started sooner, and if you ask anyone who started investing or anybody who's older than you when they started it, they'll tell you that they regret not starting earlier than they did. And I think it's because we think we have time when we're younger, right? When we're in our teens and 20s and even our 30s, we feel like we have a lot of time to start investing later on in our life, and we don't really have to worry about retirement or, tomorrow or the future. But that's really not the case, right? You have time now, that's true, but if you don't take advantage of it, that's where you're going to have regret later on in life, just like the people that I mentioned. We also feel like we can't afford it sometimes, or that we have to make more money or wait till we have our life together, whatever that means. But the truth is, there's really no perfect moment, right? The only time that actually exists is today. And so if you start investing today, it's going to be way better than starting tomorrow. And even if it's something like 10 bucks a week or 10 bucks a paycheck, that's better than nothing. At least you're starting the habit of putting money into things that are going to grow over time. And so plant that seed now to allow it to grow to a massive oak tree later on in the future. And by the way, investing isn't punishing yourself or depriving yourself. It's actually giving your future self, your future you, a gift. And it's the gift of foresight and compound interest and a better, more comfortable life later on for making sacrifices now. Number two, invest for the long term. The only way compound interest is going to be on your side is if you have a long-term mindset in this game. And when I say long-term, I don't mean 6 months. I mean to think in decades, not days. And if you're lucky enough to be in your 20s or 30s right now, you have so much time ahead of you that even if you make mistakes right now, or even if you buy some investments and they go down for the next few years, you still have 3-4 decades ahead of you to let that fix itself, to compound and to grow and to actually turn into something that's going to dramatically benefit your life. Right now, if you're in your 20s or 30s, you're starting to ramp up your earning potential more than you ever have before. So take advantage of all that extra money. Don't go spend it on stuff that you don't really need and let lifestyle inflation take away all that extra money you're earning. Instead, take that extra money and put it into the market so that it grows and your money gets to work for you. The more money you can put away now, the faster your wealth is going to accelerate. Number three, investing gives you freedom. The best path to financial success is owning a business. The second best path is actually going to be investing in something. See, without investing, your wealth is directly tied to your income that you work in your 9-to-5 job. And so that means if you want more money, you have to work more hours. That's pretty typical for most of us. But that's the problem that I'm trying to get to. That's not scalable. A 9-to-5 regular job doesn't scale well, meaning you can't do the same actions and get more output. And because none of us are invincible or we're young forever and burnout is a very real thing, the only solution is to find a way for our money to make more money on its own. And so investing is the answer for most of us because it's a very low barrier to entry, especially today, and it has massive life-changing benefits. Number four, don't use leverage. Now, when I say leverage, I'm not talking about debt for real estate. That's pretty typical in the real estate world. I'm talking about leverage defined as borrowing money to buy assets, mainly in the stock market. And it's a great way to make stupid amounts of money, but it's also a great way to lose everything you have and then some. Charlie Munger famously said, there's 3 ways that a man can go broke: liquor, ladies, and leverage. Now, the truth is that you just use the first 2 because they start with an L. The answer is actually leverage. And anytime the stock market has crashed and burned in the past, you can usually find hints of leverage in the ashes. That was certainly the case in 2008 during the global financial crisis when Bear Stearns and Lehman Brothers collapsed. There was so much leverage or borrowed money on the table for all of these big banks and really all of America just in general, because people were borrowing money to buy houses that they really couldn't afford, or maybe they didn't understand it and there were a lot of predatory loans. And so the whole thing was very unclear and sketchy. And the biggest reason for that is people were using leverage. They were using money that they didn't have to buy stuff that they probably didn't need. And I've also experienced this on a personal level in my own stock trading portfolio that I have. In 2020, when the market crashed in March, I bought a stock called NRGU. It was like a 3x leveraged oil stock. That's right around the time when oil went upside down. And it was like negative 37 or something crazy. And so I bought a 3x leveraged oil stock because I saw that it had tanked a bunch and I figured it would really continue to run up from here on out. And turns out I was wrong at that moment because it's a 3x leverage. If I lose 33%, that means I lose the entire position. And so I logged into my brokerage account one day and I looked and saw that I had a margin call from TD Ameritrade. It's now Charles Schwab, but I had a margin call from them, meaning I owed them a lot more money to put into my account. Otherwise, they were going to close out my trade for me, and it's a guaranteed loss. It was a whole mess, and it was really scary to look at because I could lose a ton of money, and I didn't fully realize what I was doing. And so if you ever see any type of 2x, 3x leveraged ETFs or stocks, and you don't really know what you're doing, I would recommend staying away from them. Number 5, buy index funds. An index fund, if you don't know, it's an investment that has a bunch of companies grouped together that you can buy all at one time. For example, the most popular index fund tracks the S&P 500, which is just the top 500 companies in America, companies like Apple, Microsoft, Walmart, Amazon. The really big ones that everybody knows about, those are in the S&P 500. And so if you want to be an investor in those, you could, one, buy each of those companies individually, but that would cost a lot of money and it would take a lot of time and you have to track a bunch of individual stocks. That's a whole mess. I think it's far better to just buy an index fund, get a piece of all of them, and then you get to join the market. Meaning whatever the stock market makes on a yearly basis or loses on a yearly basis, you're going to be part of that. And so over time, it's earned around 10%, 8 to 10% for the long-term average. That's pretty good. It's pretty much what most people should do if you're not going to be a stock picker. So the actual ticker symbols that you look up to buy an S&P 500 index fund, you could look up something like VOO, which is Vanguard's one. You could look up SPLG or SPY. All of these have the same things in them. They're all the top 500 companies. The only difference is that they're from different companies themselves and they have different expense ratios or different fees. And so SPLG in that example is the lowest fee. So if you're going to buy one, I would recommend that one if you're worried about paying fees. So the other benefit of buying index funds is that if you buy an individual company and that goes down, you lose that entire investment. But if you buy an index fund like the S&P 500 and one of those companies goes down, let's say Apple goes down for whatever reason, you're only losing the portion of Apple that was in that fund, and you have 499 other companies that can help keep you afloat. And so it also helps lower your risk. Number 6, invest on a regular basis. There's this strategy in investing called dollar cost averaging, which just means that you're buying the same thing at certain intervals. So like every time you get a paycheck, for example, you put a certain amount of money into the stock market, and let's say you put $200 or $250 into SPLG every single paycheck. That would be an example of dollar cost averaging, and it's really one of the best ways for people to get a decent strategy in the stock market without dumping a bunch of money all at once right before a crash might happen, which is annoying. Or if people are just afraid to start investing, this is a really good way to kind of get your feet wet. You're just putting a little bit at a time, and you get to see that it slowly grows faster and faster the more that you do it. And then once you start that, you're just going to be hooked. And the best part about dollar cost averaging and investing on a regular basis is that it keeps your entire investing strategy very simple and straightforward, which brings me to number 7, which is automate your investments. Pretty much every brokerage allows you to set up automated investments, but my favorite one personally is Fidelity. They're really great to work with. They have a simple interface and process to go through. What you can do is open up an account like a Roth IRA, for example. You can connect your bank account to it. Then you set up recurring investments, and you can buy something like SPLG, VOO, or maybe even some individual stocks if you want. It really doesn't matter, but the point is that you can customize your recurring investments to whichever funds that you actually want to pick, and then you can link your bank account. There's a little button at the bottom that says link your bank account, and then it's going to automatically pull whatever amount that you set it to from your bank to Fidelity and then into those funds, all automatically, fully hands off. And then you don't have to think about it anymore. So now you get to be an investor and do the things that you actually enjoy day to day, so you get the best of both worlds. Number 8, stick to what you know. Last year I learned this lesson the hard way, and I was practicing different option trading strategies, mainly selling weekly options on certain stocks. And it got to the point where I was making 2 to 3 grand every single month, and I was feeling a bit confident in my strategy. And then I got on Twitter and I found other people were making a lot more money on things like leveraged stocks, which I should know to stay away from at this point, but I figured they were making a lot of money and it seemed really easy and the market was only going up, and so there was really no way to lose. And so I didn't do any research on these stocks or these ETFs that they were recommending, and so I just started selling options on them, and one in particular, SOXL, I think it's a leveraged semiconductor stock. Anything in the AI semiconductor world was really taken off earlier this year, and so I thought, there's no way I can lose. Nvidia's going up, anything semiconductor is going up. I'm going to sell puts every single week, and eventually in July, late July, early August of 2024, The market took a pretty big dip very quickly, and I lost $6,000 in like 2 weeks. Right after that, I deleted Twitter, or X, and I no longer take anybody's advice for any investments whatsoever. It has cost me more money than I care to lose, and it's just a bad idea. That's what all the great investors talk about. They basically say stick to your lane, stick to what you know, and make your own decisions about the market and what makes sense for you. That's what I would recommend for you as well. Number 9, don't overcomplicate investing. So like I mentioned before, if you stick to what you know and you automate investments and you buy index funds, that's a really solid strategy to build wealth over time consistently, and consistency trumps almost every other approach that exists out there. So for a more concrete, simple strategy, you can look up something like the 3-fund portfolio. And this is where you have a mix of 3 ETFs or 3 index funds that kind of gives you a good exposure to a lot of different types of investments. And so one example of a 3-fund portfolio would be to have something like 40% in an S&P 500 fund like VOO, 30% in something growth-minded like SCHG, and then the other 30% in something more dividend and slow-moving but safer investments like SCHD. Now, all of these are really good funds and they have great track records and really good returns over time, but definitely do your research on whichever one makes sense for you. But just check out something simple like the 3-fund portfolio or even just a 1-fund portfolio. The point is, don't overcomplicate it. Number 10, don't be intimidated. Wall Street and legacy media likes to make investing seem like it's far more complex and sophisticated and fancier than it really is. But don't be intimidated by all the investing jargon that you hear out there. All of the big words, all the fear mongering, all the talk about the Federal Reserve and interest rates and inflation and the ISM manufacturing report. Like, all of this stuff is really just macroeconomic noise. And if you know anything about economists, you know that they're about as accurate as weather people.
Boom, roasted.
So I wouldn't worry about what they're talking about in the first place. Just focus on your very consistent long-term strategy, because if you stretch out your time horizon long enough to something like 20 years or longer, the stock market has never had a rolling 20-year period of negative returns. If you're focused on the micro and what's happening right now, it can be very intimidating and scary. But if you just stick to the long term, you have a goal in mind, and you block out all the noise, you're going to be just fine. So don't be intimidated and don't complicate it. Number 11, use tax advantage accounts. Now, you may have heard that you should invest in something like a Roth IRA, kind of like I mentioned earlier, but nobody really tells you what it does and why you should care. When I say tax advantage accounts, I'm specifically referring to things like a 401k or an IRA, an individual retirement account. Now, both of these accounts can help you avoid paying taxes, or at least you get to choose when you can pay taxes, which is why they're referred to as tax advantage accounts. And with a 401k, you can have a Roth or traditional version, and with an IRA, you can also have a Roth or a traditional version. A Roth just means that you pay taxes right now, and then your investment gets to grow tax-free, so when you take it out, you're not paying taxes. But a traditional means that you don't pay taxes now, and then when your investment grows over time, you pay taxes on that really big amount. Now, here's the way I look at it for which one you should choose. I think for most of us who are working regular 9-to-5 jobs, I think we're gonna make more money in the future than we are right now. That's pretty typical. As people get older, as they get further in their careers, they make more money. And so a Roth makes sense for most of us because we want to pay taxes on a small amount of money now and then let that grow really big later on, versus skipping out on paying taxes now, letting it grow to a ton of money, and then paying taxes later on that big chunk of money. And so that's why I recommend Roth to a lot of people. But the other side of it is, if you are making a lot of money now, let's say you have a really successful business and perhaps you want to retire early, it might make sense to use a traditional account in that scenario, because you want to essentially hide as much income from the IRS as possible and put it into an account and let that investment grow. And then later on, when you're not making as much money, you can take out a small portion every once in a while from your investment account, and then you're just getting taxed on that small amount that you're taking out. And so one of the best things that people do is a combination of both, depending on your situation. That's really the logic that I think through when I decide, is a Roth better or is a traditional better? It really just depends on your situation. Number 12, invest for your children. Now, I think kids are the easiest to invest in because they have the single most powerful tool at their disposal: time. Now, you can use all the same principles that I mentioned earlier in the video, like investing in index funds, keeping things very simple, automating the whole process. You can do that for your kids in accounts like a 529 college savings plan or something like a UTMA account. Now, with a 529 college savings plan, this is going to be another tax advantage account that you can use to help lower your taxes right now. When you put money into it, it can grow tax-free as long as you use it for educational expenses. And then the cool thing is, as of 2024, when you take that money out, if it's not used for college expenses, you can actually roll it into an IRA for your child up to $35,000. Now, before 2024, when we didn't have the option to roll it put into a Roth IRA. If you took that money out and your kid didn't go to college and you didn't use it for that, you would pay tax fees and some penalty fees. And so that's why I would often recommend to consider a UTMA account for your children. There's no tax advantages for this one specifically. It's mainly just an investment brokerage account for your kids. And there's some financial aid things that come along with it, that if you have a certain amount of money in your UTMA account and then your kid did want to go to college, FAFSA, the Financial Aid Association, I don't know the full acronym, they're going to look at that and see that your kid actually has some assets, and it might affect your financial aid a little bit more than a 529 plan. And so like there's pros and cons for both of these things, but the point is, if you're investing for your kid really early on and they have a good chunk of money by the time they're 18 or 21, that's already a huge win, and you're ahead of a lot of people, and you're helping your child also get ahead early on in life. You could use a combo of both. You could just pick one or the other. It really doesn't matter. The point is that if you start now, it's already a huge benefit. Number 13, let compounding do its thing in the last half of your investing career. What do I mean by that? Albert Einstein says that compounding is the seventh wonder of the world. Compounding occurs when the investment gains that you make right now start making gains of their own. It's the part of investing where your investments feel like they've finally taken on a life of their own. And even though you're contributing every single month, it's growing way faster than what you're putting into it. And that's a wonderful feeling. And this really starts to take off and supercharge itself in the last half, or really the last 1/3 of your investing career. So here's what I mean. Let's take an example of starting with $10,000 and we add $325 every single month, which is a little over $10 a day. And we earn around a 10% return, which is the long-term average return of the stock market. Now with this scenario, it's gonna take you around 23 years to hit $500,000. And then the cool thing is it's gonna take just another 7 years to double that all the way up to $1 million. And so that's what I mean when like the last half or even the last 1/3 of your investing career, it really starts to take off, because in this scenario, right, it takes, let's say, 20 years to hit around 300,000, a little bit more than that. So if you quit after year 20 and said, that's enough, I don't want to wait any longer, you're only gonna have 300 grand. But just waiting 10 more years triples that all the way to $1 million. And then waiting 20 more years, so a total of 40, you get all the way up to right around $3 million. And so 20 years to hit 300,000, and then 20 more years to 10x that to 3 million. So I hope you can see that the longer you wait, the faster it's gonna grow. Number 14, investing is asymmetrical. Now, I first read about this idea in the book called The Joys of Compounding by Gautam Bade. It is a wonderful investment book. It's one of my favorite. It's in my top 5. And he talks about the idea that investing is asymmetrical. And what he means by that is he's a fund manager and he picks stocks for a living. What he's learned throughout his experience, and the math proves this too, is that when you pick really good investments, when you pick things that win for a very long time and they just keep crushing, like Apple or Amazon, for example. If let's say you have 10 stocks in your portfolio, one of them is Apple and the rest of them are a bunch of trash companies that go down, and each of them you put 10% in, your winner is going to win so much that even all your losers, they don't really matter that you lost. You can be right 1 out of 10 times, and as long as that one is really right and you hold it for a long time, it beats all of the losses and then some. So let me show you a simple example here. Let's say we have 2 investments, each with $5,000. Investment A grows at 15% a year, and investment B loses 15% a year, right? And so after 20 years, here's what it looks like. Investment A, the one that wins, that grows 15% every single year, it's all the way up to around $71,000. Whereas investment B, the one that loses 15% a year, it drops down to about $220. And so even though there's a negative percentage that's the same, 15, and a positive that's also 15, the winner that keeps winning, the compounding is so powerful that even if you're right half the time, you still win really big. Even if you had 4 more investments that started with $5,000 each and you lost them, you'd still be up something like 50 grand. And so that's what I mean by investing is asymmetrical. It doesn't match, right? Your winners don't always match your losers, because you can only lose 100%, but you can gain way more than 100% in a winner over a long period of time. Number 15, don't let Mr. Market's behavior scare you away. Now, this idea comes from one of the greatest investing books of all time, which is The Intelligent Investor by Ben Graham. So if you don't already know, Ben Graham is the guy who taught Warren Buffett, the best investor to ever live, how to invest in his early career. And in chapter 8 of this book, Graham discusses the idea of the stock market being a person, and he refers to him as Mr. Market. Now, he says, every day he tells you what he thinks your interest is worth, and furthermore, offers either to buy you out or to sell you an additional interest on that basis. Often, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems a little short of silly. He later goes on to talk about how Mr. Market can also give you really good deals if he wants to sell you something at a really low price, or if he's trying to buy something from you at a ridiculously high price. You're more than happy to take both those options. But the rest of the time, you will be wiser to form your own ideas of the value of your holdings based on full reports from the company about its operations and financial position. And I think that last point is key, where if you're going to pick individual companies and pick stocks, read the full reports of these companies. Check out their 10Ks, their annual reports, and their 10Qs. Check out proxy statements. Check out the management of the company. Read through all of their financials. If you really want to be a stock picker, this is the way.
This is the way.
Number 16, buy things that turn your money into more money. I saw a post on LinkedIn a few months ago, people talking about how they thought a $900 or $1,000 car payment was normal, and that being in debt for it was a normal thing that people do. And this point isn't really to rag on cars exactly. I already made a whole video on that, but I use that example because cars are a very obvious thing that people spend money on, and that sometimes they think it's an investment when really all it does is go down in value. And so if something goes down in value over time, pretty much guaranteed, inherently, fundamentally, it is not an investment. It's a liability, and you're better off avoiding those purchases in general as best that you can if your goal is to build wealth. Instead, it's better to buy things that help your money grow and make more money for you. And you can think of it like planting a bunch of seeds if you're a farmer, right? If you plant a little bit of seeds, you're only going to get a small crop, but if you plant a bunch of seeds, you're going to get a massive crop, or at least you're going to have the opportunity to have a bigger harvest than you would before. And so the more generously you plant now, the more things that you put money into that are going to grow over time, the more that you add to your investments, the bigger your harvest is going to be later on in life. And I don't care exactly what this is. I'm more of a stock market guy. That's what I know. But you can do things like real estate, individual stocks, ETFs, bonds, crypto, or even buying successful businesses if that's what you're good at. The point is, wealthy people spend their money on things that make them more money. So pick an investment type and let your money get to work. And lastly, number 17, debt is negative investing. So I've had this idea in my head for a while that debt is basically just negative investing. And this came to me when I looked at big businesses that make a ton of money basically out of thin air using loans or interest. Things like credit card companies or banks. They make a lot of money through the same approach that all of us try to make money when we're investing. They give away their money and they earn interest. But if you're on the other side of it, if you have a credit card or you go to a bank for a loan, you're receiving money and you're paying interest. And so these credit card companies and these banks are massively successful, and they have a ton of money and they have really good margins. So I thought to myself, I want to be on the other side of it, right? I don't want to work for a bank or a credit card company, but just the principle of I want to be the one earning interest, not paying interest. And so one way to get a guaranteed return is to pay down your debts as fast as possible so that you actually have money to then invest and earn interest instead of spending all your money paying for it. I hope you liked that video. Let me know if there's any investing lessons that you learned over time that maybe I skipped over, or if there's any adjustments that you would make to this. I'm always open to learning, and I think you guys have a lot of really good comments and suggestions for this stuff. And so leave a comment, let me know what you think about that. Make sure to like if you like this video, subscribe, and we'll see you in the next one. Peace. Tickle. Now with this scenario, for your child, what?